just wanted to revisit the rankings of our large cap coverage in oil and gas. Really hasn't been a reordering so much, but the field is moving. So Oil Search is still number one. I think that's no great surprise to our network. I've been trumpeting on for a while about it, but especially now that it's come back under selling pressure. So yeah, I really did publish on it recently and have talked about it a lot, so I won't go into great detail, but really just see it as a big corporate target. The operation of PNG LNG running well above nameplate, which really delivers zero cost expansion for the company, and just see it as good value. Number two is Woodside, and I'd have to say that Oil Search and Woodside are really opening up a big gap on the field in terms of value in share price. So both of them are trading around the... if I back solve both of my models to try and work out what current oil price is factored in for both into their share prices, you actually get $46 for Woodside and $47 for Oil Search at the moment. So they're both trading roughly where the spot Brent price is. That's the first time that's happened for both of them in 2 years of coverage. So really, I see that as a big value buffer on the bottom, really defending how cheap both of them are on a relative sense at the moment versus the rest of the field. So in terms of Woodside, if they do one more deal like the Senegal acquisition, which they haven't yet fully locked away, but it looks like it's pretty well done, that would really boost my impression of their strategy around M&A. That was a really good acquisition, and I think they're in a hunt for a couple more. So if any of those come in, that's going to be a big value lever for the company. As I said, trading on $46 at the moment oil price, and any sort of weakness from here, be happy to buy Woodside, but at the moment it's trading in line with our valuation. Number three, after a bit of a gap, is Origin. We still like the company. There's still their retail and generation assets are still pumping in $1.4 billion of EBITDA a year. That's a big chunk of cash flow that is largely immune to the oil price, and really does just give them something of a buffer in terms of their cash flow and capital management. So far, we've seen APLNG ramp up smoothly. That's really where the leverage comes in for their cash flow. Any increase in oil price from here will see an astronomical increase in cash flow performance for them, given APLNG is just starting to ramp up Train 2 now. So volumes will increase, hopefully at the same time that oil prices improve, and would greatly change the picture for their cash flow. So Origin is a turnaround story. It's not in the same league as Oil Search or Woodside, but we do see value there with a $6.40 price target. And finally, Santos. Once upon a time, we were long and wrong in research on Santos. Unfortunately, the company didn't pull the levers to sell the assets when they could to boost the balance sheet. They're still back in that same position now. So on the current oil price and LNG spot price, they're barely trading at break even at the moment, which is quite concerning. They are the highest cost of the big four oil and gas producers in Australia. They really need to sell some of these assets. So the CEO did say, even to a round table of analysts the other month, that 23 of their 28 assets account for just 5% of the company's value. I've got the complete same opinion. I really do think they need to start moving on these asset sales, and they're happening too slowly. And with no real big momentum on the asset sale front, and still struggling in field, and the fact that they're trading at break even on spot commodity prices, I still just think the Santos is in the too hard basket. The reason I don't have a sell recommendation is the fact that we are bullish on oil, and if oil does rise, it'll essentially bail them out, and you'll get a big re-rating anyway. So yeah, just to recap: Oil Search 1, Woodside 2, Origin 3, and Santos 4.